Welcome back to part two of our discussion on how to lower your taxes with real estate investing. Now, if you haven't watched the first part, the first video, I would highly encourage you to do so, and I'll put the link below this video. Now, part one, we actually introduces the concept of real estate depreciation, passive activity loss rules, and material participation. Now, it'll give you a little bit better understanding of how to leverage depreciation to offset your W-2 and 1099 income with real estate. And if you have already watched part one, then I'd like to welcome you back. And in this video, we're actually going to take a deeper dive into real estate investing. And one of the things that I want to discuss is something that we talked a lot about in part one, and that's short-term rentals and real estate professional status. Now, if you're only trying to use either of these two, then you really shouldn't make it the end game with regards of your real estate investing. Now, what do I mean by that? But basically, if you're solely focusing on acquiring real estate professional status or running a short-term rental business without a real interest in building a solid real estate portfolio, then really you're setting yourself up for potential failure. The reason being is I have seen investors enter the real estate market with the sole intention of just offsetting their active income, their W-2 or 1099 income. And in the process, they often neglect the quality of the real estate deals that they're actually entering into. Now, when the market fluctuates, which, as you know, it eventually will, they will sometimes find themselves stuck with properties that are vacant, or they're really not producing enough rental income to cover their mortgage. Perhaps they've already taken advantage of accelerated depreciation, and they now realize that the property really just isn't a great long-term asset due to poor cash flow. Now, while real estate can indeed be a powerful tool for offsetting your income, it's essential to approach it strategically and with the right mindset, okay? So you want to make sure that you want to invest in good quality real estate deals, keeping your long-term wealth creation goals in mind. And if you're new here, I'm Dr. Jeff Anzalone, a periodontist trying to get you out of the rat race with real estate. I'm not a tax advisor. I'm not a financial advisor. So if you want to use any of the things that we're talking about in this part two or part one video, make sure that you speak with your advisors on that. This is just simply for educational purpose only. Do me a favor. I have a passive income guide that's free. You can download it with the link below the video. All right. So let's get back to what we were talking about. Now, you have to realize that real estate is much more than just tax savings. It's about understanding how to find a deal where you're going to benefit from the actual principal on that property being paid down. Now, one thing that I particularly like about real estate is a concept, and it's something called the debt arbitrage. So basically what happens is you borrow money, you borrow it from a lender, a bank, something like that. And then you have somebody else, you have your tenant that's in your property. They're effectively they're paying that debt for you. And this is what I mean by debt arbitrage. So you're essentially outsourcing your mortgage payments. But if you're the one that's actually covering the mortgage payments, it's really no different than having a primary residence, right? You should ideally be in a position where you have a tenant consistently paying down your principal. Now, back in part one, we actually discussed how to use real estate losses to offset your W-2 and 1099 income through something called acceleration of depreciation. Now, to give you a quick refresher on how we do this, and we perform what's called a cost segregation study. Now, this is a process that involves identifying and separating out the cost of all the different components that are going to make up your property, aside from just the building. So, breaking down the different components besides just the actual building structure. Now, this process often results in specific items being placed into different buckets. And that could be a 5, 7, or a 15-year buckets according to the established tax regulations. Now, the government has identified all possible elements of a property that could be depreciated over time, including things like flooring, elevators, carpeting, even the landscaping around a building. These components are then assigned a specific lifespan over which they can then be depreciated. This assigned lifespan is what determines the rate at which you can write off these elements. However, the government generally expects taxpayers to take what's called straight line depreciation. And typically straight line depreciation is going to be for residential real estate, 27 and a half years. For commercial real estate, it's 39 years, okay? So straight line appreciation, 27.5 years for residential properties. Now, this approach means that you're essentially spreading the cost of these items evenly across this 27.5 year time period. The government really, they prefer this method because it's much simpler and it's straightforward. And especially for those who might not fully understand the concept of accelerating depreciation. Now, as an investor, if you choose to accelerate your depreciation, you're essentially choosing to take more of your depreciation up front, and this is going to result in a paper loss. Now, this loss now can be used to offset your W-2 and 1099 income, but only if you qualify, what we talked about in part one, real estate professional, or you're using the short-term rental strategy. Again, if you haven't watched part one explaining these two strategies in detail, I'd highly encourage you to do it for better understanding. However, an important question to consider is this: what is the downside to accelerating the depreciation? You may be asking yourself, am I going to have to pay taxes on that depreciation in the future? And the answer is yes. So something called depreciation recapture tax. Now, this is a tax provision that allows the IRS to collect taxes on the gain realized by the seller from the sale of an asset. This applies that all landlords or anyone who rents out their property will have to pay depreciation recapture taxes when they dispose of their rental property. However, it's important to consider your approach to real estate investing. Again, are you a short-term investor or are you a long-term investor? So short-term investors, what do? They often flip properties, right? They buy, they rehab, they renovate it, and then they sell them quickly for a profit. Now, if this is your approach, then you need to account for potential depreciation recapture in your investment planning. But on the other hand, if you're like me and you're a long-term investor and you tend to hold properties for extended periods, often benefiting from rental income and long-term appreciation, that's the big difference. So the difference in the short-term style and the long-term style, it can really affect your tax strategies and potential liabilities. So you really need to figure out which route that you want to go. So let's look a little bit deeper into potential consequences of accelerating depreciation using this cost segregation study. So as you get into real estate and you choose to get one of these studies done by an engineer, again, this is where you segregate out all the components of a property and you write them off into 1, 5, 7, or 15-year buckets. You're essentially reaping those benefits up front. However, remember, it's essential to consider the repercussions of selling the asset in the near future. Then it's recommended, after you do the cost seg study, to use that accelerated appreciation, and it's really more beneficial for that long-term investor person I was talking about. Here's why. If you sell your property, all the depreciation that you claimed on your tax returns in previous years, they're going to return to you in the current year as ordinary income. Subject to what? Ordinary income is subject to ordinary income tax rates. Now, any amount of depreciation that you did not accelerate, it's going to be taxed up to 25%. Then any gain that you made on the property, if the property went up in value, right? So the true capital gain or the appreciated amount when you sell, it's going to be subject to something that you're more familiar with, and that's the capital gains tax rate. And that could be, depending on where your income is, taxed at 0%, 15, or 20%. Now, many people incorrectly believe that when they sell a property, they're only going to be subject to this capital gains tax. This isn't true. Now, again, if you accelerated the depreciation on a property, you're also going to have to pay that depreciation recapture tax, okay? And this can come sometimes as a nasty surprise for many, especially newbie real estate investors that actually go through the process the first time. Therefore, real estate investment, again, it shouldn't be a short-term game, especially if you believe in staying in real estate for the long haul like me and eventually passing it on to your heirs. Now, for a long-term strategy, your goal should be to have as much money as possible today to reinvest, right? Allowing you to accumulate more assets for your heirs. Now, this is where the concept of something called TMV, the time value of money, comes into play, which basically suggests that a dollar today is worth more than a dollar tomorrow. Why is that? It's because of inflation, right? I was at the airport not too long ago, and I'm looking at the vending machine, and I'm looking at the Twix, the M&Ms, the little bags of chips, that sort of thing. $1.75, $2, $2.25, $2. And I was thinking back, well, when I was in high school, 50 cents would get me a Twix bar, would get me a pack of M&Ms, would get me a bag of chips. But today, that same 50 cents, now it's going to take me $2. Why? It's because of this time value of money. 50 cents when I was in high school was worth more then than it is now in the future. It's because of inflation. So if I was back in high school in the early 90s, then my money, my 50 cents was worth more today, that day, than it is now in 2023. So if inflation is, which as you know is currently over 8%, if it's like that and you think it will continue to rise, then your goal should be to save the maximum amount of money right now. And this is where the importance of cost segregation study comes into play. Now, the real estate syndications that I've invested in the past, they use this cost segregation study to accelerate the depreciation and reduce all the limited partners, the passive investors, reduce their taxes from the passive income, okay? And that's going to give them more cash flow to then reinvest back into real estate. However, if you're a short-term investor, accelerating depreciation, it really could be a poor decision. If you plan to take these profits and not reinvest them back into real estate, essentially, you're not really growing your real estate portfolio, then you're not really viewing real estate as a long-term investment. In that case, cost segregation, again, it may not be that beneficial. However, accelerating depreciation, it really shouldn't be your only focus. You must also concentrate on really finding the right deal, which again, we talked a little bit about at the end of part one. When you're looking for a property, you want to make sure that you consider, remember those two things, the building's value and the land value. You want to look at the building's value in comparison to what the land is worth, to basically the location, and basically the likelihood of, if you did buy this property, the likelihood of paying down that mortgage quickly. You want to aim to buy real estate in areas where tenants tend to stay for an extended periods. And it's really important that the property is in a location where there's growth potential, specifically job growth, right? So finding property in the right market, remember, it's all about location. So if you find a property in the right market, you can secure your W-2 income and the wealth that you're building. As now, guess what? Remember we talked about that debt arbitrage? So now you've got your tenant that's covering your note. And you don't want to go into real estate and then just turn around and just have somebody move out of your property and you can't get that property re-rented out, all because you just wanted to save a quick buck or two on the tax benefits in that particular year. This is how many people actually get into the real estate game and then they get out of the real estate game because they feel like they've wasted money. So you might get a significant benefit in the first year through leveraging real estate professional status or the short-term rental rule. But if by year like 2 or 3, the property is vacant, then you're left with a considerable depreciation recapture tax burden. Now, real estate investing, remember, if you get into it right, you're going to be in it for the long haul. It's like a long-term game. It's like chess, not like checkers. It takes time and strategic planning. So if you believe in real estate, you really should be committed to it as a long-term investment. This means buying more properties, using the tax savings that you receive from the depreciation. And if you're like me and you like to passively invest in real estate syndications, again, you could also approach this whole investing concept the same way. I look at this as a long-term game. Consistently, year after year, investing in syndications to continue to acquire the depreciation that I'm getting from the general partner's cost segregation studies that they put on the property. So they're getting this, they're accelerating the depreciation to offset our passive income, which comes typically in the form of quarterly distributions. Now, if you plan on being an active investor and you believe in real estate as a long-term investment, let me explain to you on how to buy more properties using the tax savings from depreciation. There's actually 2 ways that you can do it. The first one is via the tax savings. Remember that you can get, so tax savings that you can get from accelerated depreciation. This means that the refund that you receive when you file your taxes, basically all the money that was withheld from your W-2 paycheck. So all of that money can be then now what? Refunded or returned to you. If you're a 1099 worker, it might mean not having to pay any additional taxes. And now you can take all this extra money and guess what? Turn around, reinvest those tax savings into future deals. That's number one, accelerated depreciation. Number two is you can actually leverage the equity that's in your existing investment properties. Now, as your tenants are paying down your mortgage, you're building up equity in your property. And many very wealthy investors, they sometimes, after this grows, they'll tap into this equity without excessively compromising their debt to income ratio. They do this by waiting until their equity has really grown significantly, having paid down a good amount of debt. They also then perform what's called a cash out refinance. They're withdrawing tax-free cash from the equity portion of the property. So they're refinancing the loan and then they're using that money to purchase another investment property. Something else that they may opt for is a HELOC. It's a home equity line of credit. Now, with a HELOC, you're not renegotiating your loan, but instead you're taking a line of credit based on the equity that you actually have in the property. Now, just like with any loan, right, it's got to be paid back over time. But accessing this HELOC, again, just like the cash out refinance, you're getting access to tax-free money, again, that you can turn around, take it, and reinvest into real estate. Now, you might be wondering, well, if I'm taking equity from one property, am I not just adding more debt? Well, the answer is yes. But here's why the wealthy use debt to their advantage. They understand, unlike Dave Ramsey would tell you, they understand that there's two types of debt, right? Dave Ramsey said all debt's bad, okay? But he's really talking about the bad debt, which is consumer debt, credit cards, that sort of thing, car debt, consumer debt, typically high interest debt. Now, the good debt, it actually comes from the mortgage system. It was created by the government, okay? Remember, get the good debt, borrow the money, tenant pays down the debt. When you're investing in real estate, the interest rates, they can range anywhere from 4 to 5% on the low end to 8 or 9% on the high end, okay? Right now, they're around the 7.5% mark, which again is much lower than the interest rates that you would be paying on your credit card, right? That could be 18, 20, 25%. Therefore, if you decide to borrow against your own property, you're borrowing from a source of good debt to reinvest in an asset that could actually provide returns higher than the 7 or 8% interest rate on the money that you're actually borrowing. Well, how do I know this? Well, I know that many investors reinvest in real estate for this exact reason. They want to stack each year, they want to stack their investments and they want to stack the depreciation. Okay. When you consider the depreciation on your tax returns, okay, so that's gradually stacking, it's growing, and the cash flow that you're earning from your tenants, then the returns can sometimes be better than what you get from like the stock market, 401k, that sort of thing, and certainly better than the interest rate with which you're borrowing it. So again, this is how wealthy investors continue to grow their real estate portfolios. However, it's important to be very cautious when you're leveraging debt. Now, this isn't a recommendation to just go and rush out and get a HELOC or do a cash out refinance. I'm not telling you to do that. Instead, I'm simply explaining to you how the wealthy operate and how they've managed to become wealthy and stay wealthy over long periods. Now, when it comes to depreciation recapture, if you're like me and you're a long-term investor, you really don't need to worry as much as that short-term investor. Many people are very apprehensive about cost segregation studies and depreciation recapture because they really aren't well educated when it comes to long-term real estate investing strategies. Now, if you're in, again, real estate for the long term, then you can leverage something called the 1031 exchange. Now, with the 1031 exchange, you can actually identify a property of equal or greater value than the property that you've already accelerated depreciation on. So if you decide to sell your property, let's say you've already got a cost segregation study, you've used up the depreciation, and you decide to sell that property, then you sell it. But before you sell it, and you want to use a 1031 exchange, you have to identify up to 3 properties within 45 days and close escrow within 180 days. By doing this, it allows you to you can roll over the depreciation, recapture taxes, okay, that you would have paid into the new property. And you can roll over the capital gains taxes too. You're effectively, this is what the wealthy do. They don't ever sell anything. They hold on to it, but they exchange it for another property. And they just keep avoiding taxes entirely until they pass away. And then we'll talk about what happens when they pass away. But here's the catch, and probably the part that you were waiting for. When you do this and you roll over the depreciation recapture and you roll over the capital gains into this new property, do you get new depreciation after a 1031 exchange? The answer is a resounding yes. Anytime that you do a 1031 exchange, you're going to take on new depreciation after you've actually adjusted your basis. Now, as you can imagine, this is a huge advantage because if you choose to keep investing, again, long term, you can execute another cost segregation study on an even more expensive property, which is going to create what? It's going to create even larger paper loss, which again can be used to offset your W-2 or 1099 income. And think about it, this strategy can really speed up your path to being able to retire if you want to. Now you might be wondering, well, Jeff, there must be a limit to how many 1031 exchanges I can do, right? Actually, you can perform as many 1031 exchanges as you want. However, as you acquire more real estate, you're going to begin to do so without leveraging all the equity inside your properties. You'll begin to use some of the tax savings you've accumulated with some of the extra W-2 income that you've saved. But here's something else that we should address as well. If you believe you'll have to pay taxes on all that depreciation one day, remember, we're going to keep investing. We're going to keep doing 1031 exchange, keep rolling everything over, keep rolling on everything over. And then you're like, well, what's going to happen when I get to the end, right? I'm going to have to pay back all that depreciation one day, right? Actually, no. And the reason is it's a tool that allows you to transfer your wealth to your heirs, which is called a step up in basis. Now, with the step up in basis, basically all of your properties, whenever you pass on, all of your properties can be released after your death to your heirs, to whoever your beneficiaries are, without paying any capital gains taxes. How about that? So this strategy actually comes into play when you establish something called a revocable living trust and transfer your real estate assets into that trust. So upon your death, your beneficiaries, your children, whoever, they're going to receive what's known as that step up in basis. That means that the original purchase price and the original purchase price of the property and the depreciation that you've claimed doesn't matter. It's stepped up in basis. So really the key factor in this whole thing is, what is the property's value at the time of your death? Essentially, your heirs' basis in the properties is stepped up to reflect the value of those properties within the trust at the time of your death. This means if your children or whoever gets the properties, if they decide to sell those properties, they can do so without being subject to any capital gains taxes that you would have faced, any recapture taxes from the depreciation that you claimed, or any capital gains taxes at all because of the stepped up basis. They would pay zero capital gains taxes if they decide to sell the assets that have actually been transferred to them through the trust. Think about it. This is a powerful tool for think about it. You've worked your butt off your whole lifetime and you want to preserve your wealth to pass along to your heirs. You want to ensure a seamless, tax efficient transfer to the next generation. Now, if using these strategies in order to build wealth excites you, but you're thinking, well, Jeff, I really just don't have time to deal with tenants. Actually, I don't want to deal with tenants. I mean, I'll treat patients all day long. I don't want to deal with tenants. But you may be thinking, but I still want to benefit. I don't want to deal with tenants. I don't want those headaches, but I still want to benefit from the advantages that real estate provides, like cash flow, depreciation, tax benefits, and appreciation. Well, if this is something that you want more information on, and it is the investments that I personally invest in, then check out this next video.